Hello, everybody, and welcome to our training discussion on auditing and specifically the overview of sampling theory. So, in this training module, we're going to be talking about just what really is sampling to begin with, why we might sample during an audit, the risks of sampling versus 100% review, an overview of some approaches to sampling, and then the basis of statistical sampling theory. So what I want to mention before we get too much further is that this is the overview section for the sampling. We are going to be going through the different specific methodologies of sampling later on, and certainly we'll talk about more detail with the sampling in later lectures, but this particular one is just the high-level overview to begin with, kind of the theory behind sampling. So first of all, when we're looking at this from an auditing perspective, and I say that because sampling is something that, yes, it exists within auditing, but it exists at a scientific level as well for a variety of different things. It exists with the census when you're counting the population of a certain area. I mean, it exists in many different things in life in general, but we're looking at it specifically from the audit perspective here. So for that reason, I have the Statement on Auditing Standards 39 that discusses or defines sampling that we can use for auditing. And it defines that as the application of an audit procedure to less than 100% of the items within an account balance or class of transactions for the purposes of evaluating some characteristic of the balance or class. So in other words, we're taking a look at a sample to determine whether we think the value is correct, whether we think that asset really exists. We're doing all of the testing on just that selected sample of units as opposed to doing 100% of everything we see on the financial statements. As you can imagine, that would be very time consuming to try to review every single transaction, every single balance for the entire year for a client. So we don't do that generally, unless there's something very high risk that we really need high assurance about. But instead, we just sample the select few items from the list, and we'll talk about that select few, what that really means in just a bit. But once we identify that sample that we're going to look at, if we review it, if we find everything is correct in the sample, that might give us some assurance that everything or most everything is correct in the entire population. So it might allow us to accept that listing without adjustment. On the other hand, if we find a 10% error rate, for example, they've overstated a particular select number of assets by 10%, if the sample was selected properly, we can, with reasonable assurance, say that there's a 10% error rate throughout the entire population. And we can project or extrapolate that error rate to that entire population and make an adjustment accordingly. So this is not really guesswork. It is scientific. Now, there certainly are types of sampling that are not as scientific, and we'll talk about that a little later as well. But I just want to mention here that the idea of sampling is we review some things to get a better idea of what we would find if we had time to review the entire population. So this gets us back to the discussion of absolute assurance versus reasonable assurance. We talked about that in another module. As auditors, we're not trying to provide a guarantee that everything is perfectly stated on that financial statement. We're trying to provide reasonable assurance as to whether there are any material misstatements in that financial statement. So the fact that we're willing to live with reasonable assurance allows us to do this somewhat lower level of review, the sample, instead of testing 100% of the items. Audits, certainly financial statement audits and most audits, are not really expected to provide absolute assurance. There might be some, not necessarily financial audits, but some different types of audits where a much higher level of assurance is needed. And in that case, you'd have to do a lot more work. But for the short time period that a financial statement auditor has to do an audit, we're willing to live with reasonable assurance. And again, it comes back down to the costs versus the benefits. Again, we've talked about that in another lecture. But what we're saying there is the cost, hours, staffing, all of that, of doing 100% testing on every single thing, it would be it wouldn't be worth it. It wouldn't exceed the benefits. The benefits of that additional accuracy from doing 100% testing, it just doesn't provide enough benefit for us to waste all that extra cost. Furthermore, we wouldn't be able to get it done within the 2 to 3 months to begin with. So when we talked about evidence in another lecture, we said sufficient evidence is required. Now, I put that sufficient in quotes because it is subject to judgment. What really is sufficient? What is enough evidence? So that's what leads us to the sampling. We're looking for sufficient evidence, not perfect evidence. The idea of efficiency versus effectiveness, which really is back to the cost-benefit analysis. Yes, it would be more effective per se to do a 100% test because we'd have a higher level of assurance and we'd have much more accurate data. I shouldn't say much more accurate data. We'd have more accurate data if we did 100% testing, but it would not by any means be efficient. So again, we're looking for reasonable assurance, and as such, we're willing to live with a sample. We want to balance the efficiency and the effectiveness, and that's why sampling comes into play with audits. Our main goal for an audit is to have enough evidence, that's sufficient evidence, to be able to defend our opinion as an auditor. If this ever gets challenged in court, if it ever gets challenged in a quality review, we can defend our opinion. Now, we might find, if we find errors in the financial statement testing, in the various account balances or whatever else we're testing in our sample, we may propose adjustments to the client, and we may have them make those corrections so that the financial statements more closely meet what we expect to see based on our testing. Now, if they don't make the adjustments, then we may have an issue with the opinion that we provide. If we find pervasive errors, for example, and the auditor or the client is not willing to correct those, that may lead us to an adverse opinion or possibly a qualified opinion, just depends on how bad it is. So we talked about the audit risk model in another lecture, and I want to bring that back up because I want to point out specifically the sampling risk. We have a risk of sampling versus 100% testing. Again, there is a risk that sample that we selected out of a population, maybe it's not really representative of that population. Maybe we found a 10% error rate in that sample, but maybe in reality, if we were ever able to find it, maybe there was only a 2% error rate in the entire population. We just happened to select more of the erroneous items in our sample. So that's the idea of sampling risk. But if we look at audit risk overall, we know that was, and there's no real required order for these, but that first line would probably be better reversed. It's the risk of material misstatement. That's the inherent risk and the control risk that an error exists in that financial statement by the time we come to look at it. So there's that risk of material misstatement, but then we multiply that by our audit detection risk. In other words, what's the risk that we're not going to find it as auditors? So that's what we start out with. Detection risk. We want to manage our detection risk. There's nothing we can do to inherent or control risk. We can identify it, we can assess the level of it, but there's nothing we can do to change it. It's there. It's the risk that something fell through the cracks with that client, and now the error exists in the financial statement. By the time we get there, the error exists. So again, there's nothing we can do about that original risk, but our risk is that we want to find the error and correct it. The detection risk, is that we won't find it, and the error will remain on the financial statements, and bad data will be provided to the users of those financial statements. So even though we can't really change inherent or control risk for that particular financial statement, we can train the clients, give them management recommendations. We can communicate with them to help out a little bit so that hopefully they'll better understand the requirements and that same risk may not exist next year. But for right now, the only thing we can do is assess it. Now, with detection risk, again, we need to manage it. Based on the risk that we found for the inherent or control risk, if it's really high, then we need to reduce our detection risk down to a low level. On the other hand, if inherent or control risk is relatively low to begin with, there's really not much of a risk that an error exists at all, then we're not as concerned with our detection risk. We can let that be a higher amount. And the idea of detection risk, it has an inverse relationship with the level of work performed. So if we have to have detection risk at a low level, then we have to do a lot of work to get it there. On the other hand, if we're comfortable leaving detection risk at a higher level, that we may not catch all the errors, but the reason we do that is because we don't think there are many errors to begin with. So if we feel comfortable leaving detection risk relatively high, then that reduces the amount of work we need to perform. Now, I talked also about the nature, extent, and timing of the audit procedures, what we do, how we do it, and when we do it. That level of detection risk that we're comfortable with determines some of these audit procedures. Now, there are certain situations where if we can't do a procedure at the best time, that may lead to a scope limitation if it's bad enough. One example of this might be a company with a large amount of inventory. If the auditor was not hired and engaged prior to the inventory count for the year, then that auditor can't monitor that and they can't observe the inventory count being completed. It may be bad enough to limit the scope and require them to document that in their opinion, possibly not even provide an opinion. They may need to disclaim an opinion if they're so severely limited in their scope because they couldn't observe that very important count for that client. So detection risk is really comprised of two different things that we're going to talk about individually. We have auditor error. So the fact is they just didn't do something right. Or we have sampling risk. And I'm going to talk about each of these individually here. The auditor error is basically the auditor not understanding something. Maybe it was complex and they weren't well trained in it. Maybe they just did something wrong. They were careless. They didn't have enough time, so they were crunched. So because of this error, they failed to detect a misstatement through their audit procedures. The way to control this error is to train better, plan better, supervise better. Now, sampling risk, on the other hand, this is estimated, by the way. We will never 100% know what that sampling risk was unless we were to come back later on and do 100% testing of every single unit, whereas up front we just tested a sample. So we tested, I'll just say 30 units out of a 300 unit population, 10% basically. So our sample findings are based on what we saw in those 30 units. But if we came back later and did all 300 and found that, hey, we had a much higher error rate than we expected based on our sample, that would be the sampling risk idea. But again, we're not going to come back and do 100% testing. Very seldom would that make any sense. For that reason, sampling risk is estimated. This is the risk that the sample that we selected, those 30 units that we selected, really weren't representative of the population. So yeah, we checked those 30 out. We tested them. We found there to be a 10% error rate. But if in reality the error rate was 25%, but we only projected a 10% error rate based on our sample testing, that's the risk. We missed out on that other 15% of errors that truly existed. It could go the other way too. We thought it was a 10% error rate. Now we find out the population overall only has a 5% error rate. So this sampling risk can be broken up into two types. Type 1 risk is erroneous rejection. That just means that leads to an inefficient audit because we keep finding these errors that we think are going to exist in the entire population, but really they aren't. They just happen to be heavy errors in the sample, even though the overall population didn't really have that many errors. The type 2 risk is erroneous acceptance. This is where it's the exact opposite, where we didn't find many errors in the sample, so we conclude that there must not be many errors in the population, even though that's not true. There were a lot of errors. So that would be an ineffective audit because we didn't catch all the errors that we should have. So now let's talk a little bit about approaches to sampling. Now this is still pretty high level. We're not talking about the sampling methods yet. This is just breaking it between two basic classes, statistical versus judgmental approaches. The question here is, what level of assurance are you trying to provide? In other words, how low do we need to keep detection risk? Do we need to keep it at a very low level? If we need to keep it at a low level, then we need to do more work. A judgmental sample, it can possibly be random, as we'll see a little bit later, or it might just be we've selected certain units just because of the way they look. We think something's odd with that unit, but it wasn't necessarily random. It could go either way. But the idea here is that a judgmental sample, as far as it's judgmental as far as the number of units we selected and which exact ones we selected, this can never be extrapolated to a population. In other words, we can't say that, hey, if there's a 10% error rate here, there must be a 10% error rate in the population. We wouldn't be able to make that adjustment. We wouldn't be able to defend it, certainly. But we can use it as a probe to identify risk for possibly expanding the sample or possibly converting it to a statistically valid sample. And it might be, of course, if we find certain errors in that sample, then yes, we know those errors exist, so we can correct for that. Now, there might be some situations where we find a very high error rate, and we just decide we're going to adjust much larger than what errors we found, just because we think there's insufficient documentation. It leads us to not trust the client and their documentation, so we may not be able to allow any of a certain asset, like certain accounts receivables. We just can't trust anything that we're getting, so we may decide to disallow that. Now, this is not really extrapolation. It's just a documentation adjustment, unless the client can get us better documentation. So the things we need to document, of course, would be the choice of the sample, the reason for choosing the sample, whether it's low risk, low scope, and in later lectures we'll talk about some examples of that documentation. As I said earlier, we can possibly use a judgmental sample just as a probe to identify whether we think errors exist in the overall population. This helps us with the risk assessment to determine whether we think we need to do more. If we found no errors in that probe sample, then maybe we're willing to trust the documentation and not do a whole lot of testing. Maybe we'll shift our efforts elsewhere. So the next question is, what happens if we do find errors in that judgmental sample? We could just decide to expand that judgmental sample to search for more errors. Again, we shouldn't be extrapolating unless we have a statistically valid sample. We might pull that judgmental sample into its own stratum and make adjustments for what we found there, but then the rest of the population, the rest of the accounts receivables, the rest of the other assets, if we have that remaining population, we could select a statistically valid sample out of what's left, and then any error rate we find in that second sample, the statistically valid one, we could extrapolate those errors just to that population. Or another way around this, to keep it with one sample, is to replace the units from that judgmental sample that we first selected, put them back into the population, and just start over, essentially. We're going to select a brand new statistically valid sample. Now, the point with this, though, is if we did find some errors, we gathered documentation, we found some errors, but now maybe some of those units that we judgmentally sampled didn't get included in our statistically valid sample. So even though we knew the error existed, Now there's nothing we can do about it because it's not part of our statistically valid sample. So you're leaving potential findings on the table, and it seems a little odd, but it's all about, do we want to use a statistically valid sample? If so, we can't deal with any of the judgmental testing we did earlier. It's either we leave it all and have a separate stratum for the statistically valid sample, or we merge it all back together and start over. When you're talking about this, sometimes you'll hear the phrase a scientific or a mathematical approach, quantitative approach, the scientifically established. What we're saying with this is that we're looking for direct testing and adjustment of a unit. So a particular accounts receivable, we've tested it. We've tested a certain patient, a certain customer, and we've identified that their accounts receivable is invalid. So in that case, we can remove that one unit. We've tested it. We know it's not true. But if we did a statistically valid sample and extrapolated the findings to the overall population, that's also considered scientifically established. Even though we didn't test every single unit in the population, we've used scientifically established methodologies to do our testing. We found a representative sample, and we're good to go. So now on to really the heart of this module. That was the basis of statistical sampling theory. I've touched on a few of these things before, but what we're really talking about are two concepts. First of all, the laws of probability, and for that we're talking about random selection. The other concept is statistical theory in general, and for that we're looking at the representative samples. What makes a sample representative? We know it was randomly selected, but the representative sample idea is how many units did we need to be representative. So the two do work hand in hand to give us a statistically valid sample. Now there are a few different approaches, and again I'll disclaim that we have a later module that talks about the different specific types of statistically valid samples. But for now we're just talking about some of the basics. But the random sample selection. This could be a simple random method, which means you just flat out pick 10 random numbers. Assuming 10's a good number, you pick 10 random numbers. That's the most commonly used method, depending on the software systems you use in your firm or for your class. That might be a pretty easy method to use. The next method is known as systematic random, and what that means is you start with a random number. So it was random to begin with. Let's say the first random number you pick was 17 out of your list of 1,000 units. 17. Now, if you know you need a certain number of units, then what we basically do, we'll get into this more later, but you take the total number of units in your population, divide it by the number of units you need. So let's say you needed 30 units. So you would divide, and let's say you had 1,000 units. You need 30 units for your sample. You take 1,000 divided by 30, and then you take that number, and that would become the n in this discussion. In this case, the 1,000 divided by 30 it'd be 33.333, but we're just going to round down. So what that would tell us is that we'll start with the number 17, that was the random number I gave, and we'll pick every 33rd item after that until the end of the listing. That means you're probably going to wrap around. In this case, you'd wrap around just that one time to get your number of units, to get your 33 units, or your 30 units is what I said earlier. You do the every 33rd item until you had 30 units selected. Now, this is not that well of a preferred method. If you're listing, it really depends on what asset or liability or expense or revenue you're talking about. If the items truly are randomly distributed, then it would work all right. So when we're talking truly scientific methods, like things that happen in nature, if you're testing some item like that, then this may work. But if you have a certain listing that was prepared by somebody knowing full well that they were going to be audited, they might lump certain things together in certain areas, knowing what method you might use. They're just trying to guess, but it calls into question whether or not it's the best method to use or not. Now, an important thing to note with random sample selection is that any unit in that population that may be impacted by our extrapolation, anything we're testing and extrapolating, must have an equal chance of being selected. So we can't leave it out of the list and intentionally skip over it and then still extrapolate to a population that included that item. We have to leave the item in the list. It has to have an equal chance of being selected, all of that. Now, the thing about random sample selection, we've used that term quite a bit. Most times we're not really using 100% random sample selection. And the reason for this is simply that most of the time we're using computer systems, some sort of system, again, depending on the client or depending on the audit firm you work for or what class you're taking. And computers, by their nature, are not really random. They're not 100% random. It's some sort of algorithm that's been created in the computer, in the system, the software. And there's a pattern, even though you generally can't see what it is. It's so complex you wouldn't be able to see it. There would be a pattern to it. So that wouldn't really be random. It's called pseudo-randomness, and it's certainly fine for our purposes. But just keep in mind it's not really random. A truly random idea might be coin tossing. That's certainly random. Bingo ball selections, things like that are actually random. But again, we're not going to generally do this for an audit, so we're willing to live with the computer pseudo-randomness. It wasn't impacted by anything we as an auditor are doing or anybody else, so it's random enough for us. Now, this randomness, in fact, the pseudo-randomness from the computer is needed because these computer software systems often allow us to go back into that sample later on and expand it. If we find out, hey, we found a lot of errors, now we think we need to test 10 more. So we want to still find another random sample that started with the one we already tested and expand it. They need this seed number. That's basically built into the system. That allows them to recreate that sample just at a higher number of units now. The biggest thing, as I mentioned, is that for it to be truly statistically valid, the auditor or anybody else, they could not have been able to intervene in the selection. In other words, they can't say, well, yeah, I know I should be testing unit 10, but unit 11 looks a little weird, so I'm going to test it. They cannot do that. It would not be a random sample at that point. Now, the auditor's judgment can come into play later on, or I shouldn't say later on, earlier on when they're determining which strata do they want to create. A strata is basically taking the overall population, a stratum is singular, strata is plural, but a stratum, when you stratify, you take that overall population and you've broken it up into meaningful groups because each group might be different. So out of this group, you've decided to test for certain things, then you extrapolate the errors of that group just to its own population. Then in the second stratum, you test a few other units and you extrapolate just to that one population. So that's the key thing here. Your judgment can certainly be used for that, but once you're within a stratum, once you're actually selecting the sample, you cannot be using your judgment on which exact units to test. If you do, you've destroyed the randomness of that, and you're back down to a judgmental sample at that point, which may be fine for your level of review as well. So again, the random sampling tells us which units did we want to pick for testing and in which order. Statistical theory tells us the quantity that we overall need to test. So the idea of statistical theory, we get into this in more detail in later chapters as well, later modules. But the idea is that we're trying to find representative samples based on predetermined degrees of reliability, and the goal is to have that sample be representative of what we would find in the overall population if we were to test 100% of the items there. But again, it's not going to be perfect, And as I say here, it's a science of estimation, not exactitude. So we're not trying to be exact. We're trying to provide reasonable assurance within predetermined degrees of reliability. So the sample size determination overall is going to be determined by a few things. First of all, the sampling methodology. Second, the sampling design. And the characteristics of the units in the population. What risk existed. Now, as I said a few times already, different CPA firms, different schools, different courses have different tools that they require you to use for sampling. The government has one that they use. Where I work, we have one that we built internally, and generally they're based on either some sort of just computer software in general, or sometimes they're built out of Excel. Again, there are a variety of other ways to do this, but that's the general approach to it. So that takes us through this overview, and I hope this gives you a good feeling on what's coming next for the later discussions on sampling, but this is just to get the ball rolling, get the concepts out there. We're going to dig in more deeply for many of them, but I thank you for your time, and I will talk to you in our next lecture. Thanks.